$792K. It's pretty good.
I think they're getting the better end of the bargain because if someone from Singapore wins the Olympics, did you know Singapore has mandatory national service similar to Israel? And Singapore is the most religiously diverse nation in the world. And they very definitely decided that we are going to be so prone to ethnic violence with all this religious heterogeneity that we need to get people more focused on the flag. And so they decided to do national service.
I think it's a great move. You also go to jail if you leave gum on the ground. Is that not true?
That's actually not true. It's an offense. But I will tell you this, though. I was in Singapore about a month ago, and you have never seen a guy my age go through his luggage more carefully to make sure that that joint from 2 years ago wasn't floating around in a pocket somewhere.
Has that ever happened to you? You accidentally had some detritus?
Detritus?
Yeah, some leftover paraphernalia.
Detritus? I thought that was some sort of gum disease. I think I saw my periodontist for that. No, I have a very healthy fear of prison, and I don't travel with edibles or I do travel with prostitutes.
Keep in the luggage.
That was dark. Just like the kind of guy who would think Africa is a country, not a continent. That was dark, Ed. No, I don't travel with edibles. No, I lose stuff at TSA. They don't find stuff on me. Although they did pull aside Drew one time when I went to Mexico and brought him with me because I needed, my technical support animal, Drew Burrows, to make sure that I could set up. And they pulled him aside and they basically said he had to pay, a couple $100 or a couple $1,000 to get our equipment back. But, that's Mexico. That's just part of what you go through when you go to Mexico. But no, have you ever been caught with drugs, Ed?
No, that wasn't the point of that question. No, I haven't. Thank God. Have you ever been arrested? Have you ever gotten in trouble with the law?
No, I've never been arrested. I have been called several times by people who've been arrested. I'm that guy they call because they assume I'm rich and that I know I have contacts. And so I get those calls from prison. I've had 3 calls from people who've been arrested just in feels like the last year, but it's probably the last 2 years.
Wow, so they want you to bail them out?
Well, unfortunately, I learned this. There's not a whole hell of a lot you can do. What you do is you immediately try and call a lawyer, you go down to the station, and all you can do is provide sort of emotional reassurance and have a lawyer lined up. It depends when it happens. I know way too much about this, which probably speaks to my friend group. But it's mostly stupid shit like DUIs and stuff, but which isn't stupid, which is dangerous. And Africa is a continent, not a country. So, but there's not a hell of a lot you can do other than make sure you've lined up a really good lawyer. But I think people are under the impression like I'm going to show up with a bag full of cash and just spring them or something. It doesn't work that way. Sometimes you can just show up with a bunch of cash and make bail.
Right.
But generally speaking, if you get arrested, what happens is your lawyer says, well, he or she's going to go through the system and it's going to be a few hours or a day. What you don't want is to be in a smaller jurisdiction arrested on a Friday after like 5 p.m. because that means you're not seeing the judge till Monday.
This is good to know. I did not know that if I ever get in trouble with the law, I can hit you up. You won't bail me out, but you'll offer some emotional reassurance and line up a lawyer, which is all I need. That's great.
I'm going to come up with nicknames for your prison name and just make fun of you.
Honestly,
white bread.
That would be great.
White bread. Tasty Ed. Tasty Ed.
All right. Shall we get into our conversation with Professor Aswath Damodaran?
We should.
Let's do it. All right. Here's our conversation with Professor Aswath Damodaran, the Kirshner Family Chair in Finance Education and Professor of Finance at NYU Stern School of Business. Professor Damodaran, thank you for joining us once again on Prof G Markets.
Thank you for having me.
So last time you came on, it was probably our biggest episode of the year. It was striking to both me and Scott. It was striking to our audience. A lot of people were writing about it. A lot of people were talking about it because your view was that valuations across the board were too high. And you told us that there was no place to hide in stocks. That was how you framed it. And we had a wide-ranging conversation, and one of the conclusions that you put forward is that perhaps, the traditional wisdom in stock market investing was maybe not as true anymore, at least not right now, based on valuations. You were looking at getting into collectibles. How has your position changed or not changed since we last spoke? Do you still believe that there is no place to hide in stocks?
If you look at the level of the S&P 500, the time that we talked in, I think, early November, it's about the same level as it's today. The market's kind of flat. And it's, we've had up days and down days. You've had periods of crisis. Here's my biggest issue. One is, if this were the equity risk premiums that we're seeing in the market, what people are pricing stocks to earn is roughly what they were pricing in 2005, 2006, 2004, going back in history. And I think that if you just looked at the numbers, there are ways you can justify it. You can say, oh, what's the big deal? The real issue that you face is, I think the potential for catastrophic changes is much greater now than perhaps at any time in the last 70 years. Catastrophic changes in what way? I mean, after the Second World War, we put together an economic order centered around the U.S. and the U.S. dollar, and that's coming apart. You can see an acceptance that it's coming apart. You saw it last week in the political discussions you saw in Europe about where are we going next. But clearly, now, the old system is coming apart. There's nothing to replace it. That's where the catastrophic risk component comes in. And the market seems to essentially be blowing by, saying, it doesn't matter. We're going to figure out a way. And just like we did on COVID, and maybe that's part of what's going on here, is people are saying markets are resilient enough. They're going to find a way, even through this dramatic change in how the global economy is run, to find the other side. And I think that what investors don't seem to be factoring in is there are going to be pitfalls along the way that have to get priced in. So my concern with stocks is not the 1999 level of concern, which is, hey, stocks are crazy. You can't justify this pricing. It is, we can justify the pricing if you assume that there's no catastrophic risk to worry about. But if you do bring in catastrophic risk, then the market becomes worrisome across the board. Whether it's Mag 7, not Mag 7, global equities, U.S. equities, collectively, there seems to be too much of an acceptance that we'll figure a way through this without serious pain.
I'm already feeling bearish again. So I guess one thing I would push back on, it sounds like what you're describing is a collapse in the global order, the way the global economy is set up. Which to me sounds like a U.S. problem.
I don't think so, Ed, and here's why.
No?
Right?
Okay.
I mean, the U.S. has benefited from the world economic order, but so has much of the rest of the world. Europe has lived in the reflected protection of the U.S. for 70 years and essentially been able to focus entirely on economy building, leaving defense and the expense of defending Europe to the U.S. So this is not just a U.S. problem. The U.S. might have more to lose than everybody else because it's been at the center of the post-World War II economic order. But it's not just the U.S. I have a feeling that this is going to be pain that percolates in every direction, that this adjustment, it's not so much a collapse, but there's got to be a new economic order that comes out of this. Right. How we get from where we are now to that new economic order is what we should be thinking about. And I don't think it's going to be as painless and as easy as markets seem to be pricing in. I mean, how do you go from the US dollar as the central currency to something else? Because there's nothing else out there right now that can replace the US dollar as a global currency. So I think that transition, more than a collapse, is what's going to be painful, because there are going to be some businesses that are going to find a way to get to the other side easily, and other businesses are going to struggle more. But I think that struggle's got to be priced in more, and whether that means a correction of 10%, 20%, 25%, we can debate. Because I think that correction has to occur somewhere along the way as this transition plays out.
Do you think that the correction will be a function of a slowdown in the fundamentals of businesses all across the board, or is it more of a sentiment multiple problem that you're describing? Because the reason I bring this up is I feel as though a lot of investors in the markets are beginning to feel this. We're seeing this, we saw it at Davos. As you say, most people agree something about the world order is changing. We're seeing a lot more attention being paid to the deficit spending in the US. And we did see a rotation in terms of capital flows last year out of the US, or maybe out of the US is actually too harsh, but because the S&P did rise. But ultimately, every other market besides the US saw big returns. Emerging markets up more than 30%. The world minus US ETF up 30% as well. To me, it almost seems as though one response from investors would just be, okay, let's just shift our capital allocation out of the US, invest a little bit more in Europe, invest a little bit more in Latin America. I don't see how this necessarily means that everyone's going to pull back wholesale.
It's not just a rotation in geopolitics, it's a rotation in business economics as well, which is, and you're seeing this with the talk of AI and technology changing businesses. And here's the conundrum that investors face. If it were purely a geographical shift, you're saying, let's shift out of the US, that's our problem. We're over-invested in the US, let's invest elsewhere. But the problem is the businesses that are best positioned to take advantage of the business transformation happen to be US companies. So if you're going to rotate out of the US, and by the extension, you're going to rotate out of technology and the big technological disruptors in the US, I don't see how you maintain balance. So that's why I don't think it's going to be last year, as you pointed out. The S&P 500 did well. The rest of the world did better, but much of that better came from the dollar becoming weaker, not from those markets delivering higher local currency returns. So in fact, I computed the local currency returns and the dollar returns. The dollar returns are much more impressive because you get that extra 9-10% boost in your returns if you're a European stock market, if you build in the dollar depreciation. So I do think we're going to continue to see some weakness in the dollar translating into money moving out of the US, but there are limits to how much you can move out of the US without ending up being underinvested in the businesses that are best positioned to take advantage of the economic change. I mean, again, I don't mean to sound catastrophic, but I'm saying, put on your seatbelts because there are going to be adjustments. And the question you asked about fundamentals and perceptions is a good one. And I'll take one sector where you're seeing this play out. Let's take software. If you look at the margins for software last year, they stayed impressive. The gross margins were 75%. They look very much like the previous year. Revenue growth was pretty good. But clearly the perception has changed. Software stocks are down 25 to 30% because there's a concern that AI is going to eat away at margins. And I think it's well placed. Collectively, I think software is ripe for disruption because it's so fat. So many layers of profits you can go after. But I think that when you get those corrections, you're often going to get across-the-board corrections. So perception is going to mean marking down the price of all software companies. But some of them are going to find a way through this disruption to emerge as winners. So I think the same process is going to play out at the market-wide level, which is you're going to see sell-offs, and then you're going to see people re-examining some companies saying, hey, these companies are going to find a way in the new economic structure to be successes. So that's why it's going to be a back and forth. It's not going to be a one-way adjustment where everything gets marked down, we stay down. It's going to be a process where markets are learning, even as as things are unfolding, what this process is going to do to company profits.
So Aswath, let's double click on that. You've seen some of the most iconic software firms off 30, 40%. And as a multiple on free cash flow, they're trading at some of them at all-time lows. And Ed's thesis, and I think I agree with him, is that it might be a buying opportunity. Because when I look at if I think of their integration into businesses, there's the tip of the iceberg is, all right, what can be done using AI now? But below the surface is they have billing set up, they have UI, they have relationships with the company. I can't even imagine, even my last company, L2, we used Salesforce to track our leads. The idea of getting just a sales team of 5 or 6 people to retrain them on another product, I don't care if it was 50% less expensive, we wouldn't have done it. So is this an opportunity? Have these companies been oversold? The Adobes, the ServiceNows, the Salesforces?
I think collectively, yes. And I think that almost always happens when you have worries about a catastrophe. I mean, I think back 15 years when fossil fuel stocks went into free fall. This was in the early years of ESG and COPE, where people thought, hey, this is the end for fossil fuels. And they went into free fall. And then eventually they recovered because it turned out that the threat was not to a core business. The fossil fuels were still required. I agree with you that the Salesforces of the world and the Oracles are much more sticky businesses than we let on. So if you look at them, the software is only a small piece of the puzzle. It's actually the least, of all the competitive modes, it's the least of their modes. You could probably replicate their software pretty easily. But once they get adopted, they squirrel their way, if that's the right word, into your systems, your data, your processes, and they become part of your company. So it's not just replacing software, it's an entire system. Here's how I think it's going to play out. And I think this is where the software companies are looking. The problem is much of what they do now with people, which is what the expensive part is to track these processes, can be done by AI. And they're offering AI products that effectively do what their regular products are doing. But I think one of the mistakes they're making is what brick and mortar retail firms initially made with online retail, which is they worry about cannibalization. So they can't go in full force with an AI product, even if it's a really good one, the same way that somebody who has nothing to lose can go in. So I think what you're looking for as an investor is which of these companies are using AI in a way that they're willing to give up their existing product sales and replace them with AI. Those companies will make it. And which of the companies won't have their cake and eat it too, which is sell their existing products, charge the prices they do, get the high margins, and offer AI as a side product. But they're not willing to jump in. So I think that the adaptable companies in this mix will be the ones that make it. As an investor, you're looking to see how they're incorporating AI into their product mix and into their business. My prediction is the first thing that's going to get hit in software is not the revenue number. It's going to be the margin number. You're going to see margins come down even at the companies that survive. And it's been a long, great run for software. I mean, I invested in software in the 1980s when it was first coming out. It's been 40 years of really great margins. And I think that in many ways, like every other business that gets disrupted, there'll be a new steady state of lower margins, perhaps greater scale with AI, things that you could not do with traditional software. And some companies are going to navigate that divide better than others. I think the B2B companies have to be more wary because costs are going to drive a lot of choices. B2C companies, I own Adobe and I will hold on to Adobe even through the down days because I think it is a more robust software model because of what it does. I could be completely wrong, but I think we need to, you're right. I think right now it's a broad brush. All software companies are getting sold off. But I think that I would track not just what these companies deliver as earnings, because that might be too late to get the signal, but what they're doing in terms of product mix. And given that this requires talking to customers, the more you can talk to people who buy their products and services and ask, what are they offering with AI? What's different? How's the pricing of their AI products? Will give you some insight into which of these companies are going to come out as successes from this and which of these companies are going to falter and fail.
It strikes me that they're just going to come under pricing pressure. And if you think of 10 or 20% of their expenses are related to people who have a CS degree from Carnegie Mellon actually building the product with software, what's to say that they won't be able to reduce that expense internally, pass on the savings to their clients while protecting their margins? Because as someone who's sat on boards of software companies, and software has been the gift that keeps on giving, we're going to grow our revenues 11%, and we're going to grow our employment 8% and our EBITDA 12 to 15%. That's generally the story of software for the last 30 years. My thesis is there are so many fatty deposits that can be easily taken out of these software companies and they can pass those savings on. Well, it might be a hit to their top line. like you said, I think their margins and their cash flows, it just strikes me, the last time we spoke to you, we had a difficult time zeroing in on what felt like a buying opportunity. And our thesis has been that if you were to buy a basket of these software companies that have shed, $500 billion to $1 trillion, it feels like the first buy signal in a while.
I think what you're describing is what I would call an adaptable software company. You're saying the software companies that adapt to this, adjust their cost structures quickly, might be able to keep their margins high. And that's a plausible pathway. But we've been around organizations that have to downsize. This is a very different game for them than the game they've been playing. And some of them, I think, are incapable of playing the downsizing game very well because they're just not used to it. So maybe the things to watch is which software companies respond quickly and start reducing their workforces, adjusting their costs. And you're going to start to get that information pretty quickly. And those will be the companies rather than a basket of alts. So maybe we need to create a basket of software companies where their operating expenses have dropped by 10% in the last 2 quarters. That might be a better basket to focus on than basket of all software companies. Because I remember writing about disruption 20 years ago, and I said, look, if you want a perfect target for a disruption, you want to pick a company with high margins. It's incredibly slow to respond to change because they keep, we've seen, we're in a business, education, where you see how slow change is. If software were run like education, then we can safely predict that software would crash and burn, that in a year or 2 or 3 years from now, there'd be no business. I do think that the more inflexible you are as a company, the less you learn from what's happening around you, the more danger you're exposed to. So rather than buy an entire software basket, I would look at a subset of software companies where you're looking at adaptability, how quickly they're adjusting to costs and adjusting their cost structure down.
On 2 companies, the 2 biggest LLMs, Anthropic and OpenAI, which I would argue are technically public companies. You can buy shares in the secondary market. I believe Anthropic's raising at $350. OpenAI, I believe, is trying to close around at $850. Yeah, I'm curious what you think of those respective valuations on the companies. And our thesis has been that Anthropic is actually, I don't call it underpriced, but we think that there's going to be a flip in valuation, that Anthropic has more momentum, more enterprise, and that OpenAI is a bit more consumer, more vulnerable, and quite frankly, it's just endured a lot of negative PR, which feels like negative momentum. Have you looked at either or both of these companies and their respective valuations?
I think I'd pick Anthropic purely based on the ego of the people running the company. This is a space where I think if you have smart, egotistical people running the company, you're in danger because they're going to overplay their cards. And with Sam Altman, my feeling is he might be a smart guy. He might have a good set of cards, but he's always going to overplay those cards because he believes his cards are better than they truly are. So from a purely because this is going to be a space where you require managers, again, the adaptable word comes in, to learn from what's going on and change the way they behave. I'm not sure OpenAI is capable of that learning and change that Anthropic is. I find, to be quite honest, from an intrinsic value standpoint, I would be hard-pressed to invest in any of these companies at the existing pricing because collectively the pricing just seems too rich to me. But on a relative basis, if you need an LLM in your portfolio, you're much better off with, Anthropic is lucky in terms of who it competes against. OpenAI, basically you can go down the list and given its, that peer group, it might be the best of the LLMs to have in your portfolio if you want one in your portfolio. I'm not particularly eager to have any of them in my portfolio. So for me, they all look pretty richly priced. But if you force me, I'd pick Anthropic over OpenAI.
One thing that's so interesting about this dynamic is the fact that they are both private, which seems like a setup that we've never really had before. The idea that the 2 largest names in the largest, hottest space in the world are not publicly traded.
Are you bringing an XAI into the mix as well?
And XAI would be another example as well. And I think one thing that has been kind of frustrating for me as someone who follows the markets as an investor as well We saw this gigantic destruction in value in software as a result of these AI tools. $2 trillion in market value just erased over the past couple of weeks, because the idea is Anthropic's going to change the game, OpenAI is going to change the game. And yet I haven't been able to see how those stock prices are moving. I mean, presumably you'd think, okay, well then did the $2 trillion just get transferred to OpenAI and Anthropic? Is that what's happening? But I don't know, because they're private. So I'd be interested to hear your views on how new this is and how this changes the dynamics of being an investor when we're seeing one of the largest technological revolutions in a really long time.
This is a process that's been unfolding for 20 years now. This private market, a gray market almost, not quite public, not quite private, where you get public market investors invest. I mean, I think of Uber raising, when it was $65 billion, raising money from Fidelity and T. Rowe Price and the Saudi Investment Fund, effectively looking like a public company on many dimensions, but staying private. The problem with staying private is there might be pricing out there, but it's often stale and it'll often lag the real world. It would be nice to observe what the LLMs are being priced at, but I think there's your initial lead-in, I think, was a very critical one. You talked about value destroyed in one business and a value created in another one. And one of my problems with the AI pitch for much of the last 2 years was, hey, look at all the good stuff that will come from AI. We gave the market the benefits of all the good stuff that came from AI. We pushed the market up. But nobody seemed to be talking about the disrupted and what it would mean for them. So software, in my view, is the first card to be dealt out of that deck. And there'll be other cards that come. I mean, how much is Accenture going to be worth when AI becomes as powerful as people? If AI advocates are right about what it can do, there are a whole host of other businesses that are ripe for disruption, just like software is. So I think this might just be the opening lead-in into a play where we see what happens to the disrupted. The disruptors are off the market, so that's not good for the overall public equity market, because if the disrupted show up as a decline in public equity value and the private companies are not part of the public equity market, the index has to reflect that loss, but it won't reflect the gain. So if nothing else, for the health of the equity market, you're hoping that these companies go public, because then at least you can get a more complete accounting for both the pluses and the minuses.
Yeah, I mean, when these moments like what we saw in software occur, our view, at least on this podcast, my view has been this is when you want to start getting active in the markets, because it seems as though there is so much uncertainty, there's so much confusion, so much fear about what may happen that people kind of throw their models out of the window and they kind of, more simply speaking, they act a little bit less rationally. They're not projecting cash flows in the way that they were in the past, because they're just so frightened about what may be or what may not be. And to me, those seem like the moments where you want to buy. And that's what I did, by the way. But also in my head is your voice saying that actually the whole thing is overvalued, that there's another layer of risk, another layer of catastrophe that isn't being acknowledged, that isn't being priced in yet, which makes me think, well, am I thinking too small here? Am I making a mistake by looking just at software? Should I be looking at the entire world and the fact that there is an entire global order that could collapse here? And what might that do to valuations?
You can have your cake and eat it too, Ed. You can buy software and sell short on the index if that is what you're concerned about. If you feel confident enough that your picks net are going to be good picks after correcting for the market risk. So that possibility exists, but it is costly to do it. Buying insurance against market collapses is always costly. But if that concern becomes large enough that it's getting in the way of you investing, then my suggestion is buy those stocks in this disruption that you think are being beaten up too much, and buy protection against a market correction at the same time. And that's a possibility that didn't exist 40 years ago, that you can do relatively easily today. So I think there's a way you can do this, but then you're going to be giving up some of your upside if markets continue to go up. And, but it'll give you that self-assurance of, hey, I did the right thing. I'm going to win on my winners, but the market is not going to take me down, even though I was right on the companies that I picked. Now, I think that you're right about the uncertainty issue. I do a session on uncertainty where I talk about the most common reactions human beings have, investors by extension have. The first is denial, which is you say, what uncertainty? I don't see any uncertainty. The second is mental accounting, which is you do something that worked for you 7 years ago in another uncertain setting. It's completely different, but you do it anyway. The third is outsourcing. What do? You ask McKinsey what to do. You ask Goldman Sachs what to do. Now, which is what a lot of people are doing with AI. I have no idea. As if the Goldman Sachs AI analyst is some special insight. And the fourth and the oldest response to uncertainty is you get down on your knees, you look up to the heavens, and say, please, God, tell me where to invest. I think that those are things that people do all the time. But I do agree with you that it's during uncertainty that the payoff to being systematic, to trying to do your homework is greatest, because that's when market mistakes explode. So whether it's software in this first round or something else in the second round, I would look at the sector and then start to go through the sector and start to separate the adaptable from the non-adaptable, because there will be companies that get through this and come out not just intact, but perhaps as winners, because you'll have fewer players left in the game. They'll have less competition after this thing plays out. So I agree with you on that, but it's not for the faint of heart. It is going to come with a lot of ups and downs, more downs initially than ups. I describe investing as an act of faith. Faith that you're right about your assessment of value, and faith that the markets will adjust your value. Faith because if you ask me to prove that a particular software company is cheap, I can't do it. And if you ask me to prove that even if it's cheap, that the price will adjust to that value that you got, I can't prove that either. Investing is all about faith, and your faith will be tested. Might as well be open and honest about the fact. Anybody who claims that they have absolute certainty that software is undervalued, they're jumping in. I have zero interest in following. This is not a space where you can be absolutely sure about anything. You're going to be wrong, and you have to be willing to admit when you're wrong. And that's the other thing I'd build into your investment philosophy. What are the things you're going to track to see if your investment bet is playing off? So maybe layoffs are the thing you want to track. And if the company that you're doing acts like nothing's happening, it's in denial, maybe no matter how good it looked to you at the initial round, you might say, that's not the company I wanted. So being willing to say I was wrong and go back and revisit the company you picked might be an integral part of the strategy working for you in the long term.
On the catastrophic risk that you feel that it is underpriced right now, or that the investors are not paying enough attention to, what are some data points or signals or events that have led you to believe in this notion that there are greater risks than we really understand?
I'm going to give you a strange answer. I've never been one to track the price of gold and silver. And last year was a phenomenally good year for gold and silver. Gold was up almost 70%, silver was up 150%. But what made it so unusual was gold and silver usually go up either during periods of hyperinflation, not just high inflation, but hyperinflation, 1970s, or during severe market crises where markets are down 30, 40%. Neither was true in 2025. So you're saying, why did they go up? There's a segment of the market that has always been into the gold and silver. They form the base of the market. They hold gold and silver, and that's all they hold. What makes gold and silver prices go up is that market segment gets bigger by attracting people who normally invest in stocks and bonds. So I think that when I look at the people who are warning me about catastrophic risk, it's not the usual doomsayers, not the guy on Times Square saying the end of the world is coming. These are people who are normally pretty level-headed, who talk about equity. So one of my worries about catastrophic risk comes from the people who are warning about catastrophic risk, who are not normally people who do this. I mean, there are people who've been yelling, the end of the world is coming for 17, 16, 20 years. I'm not interested in them. These are people who are not normally in that group, who are in that group. At the same time, you get these fissures show up in politics that you've never seen before. And those things, will ultimately play out, whether it was the tariffs or whether it was NATO's challenges or what's coming next. I think that those are things that are small cracks at the moment, but they're cracks that could very quickly become much bigger issues. So it's a collection of things, not one particular thing. But you can start to watch, for instance, the price of insurance against catastrophic risk and start tracking, because insurance companies are going to catch the people who are most exposed to that catastrophic risk soonest, because they're going to try to buy protection. So I'm going to try to keep my eyes on those potential indicators. So, high yield bonds. So the rates on high yield bonds tend to go up when people start to worry about catastrophic risk. That hasn't happened yet. So maybe those will be the advanced indicators. Is when you start to see those prices start to go up, you have to start thinking about creating protections for yourself against that catastrophic risk.
Is that not kind of an example of the outsourcing that you describe when there is uncertainty, which is you're not necessarily looking at the catastrophic risk in and of itself. What you're describing is there is a feeling out there, and investors are kind of saying and showing.
Absolutely. But here's the difference. Outsourcing traditionally has been to call in experts.
Yeah.
And ask them, what's a catastrophic risk? I'm suggesting crowdsourcing that. And basically, we're doing for a catastrophic risk what we've done for restaurant reviews, right? We no longer read the New York Times restaurant review, we go to Yelp. And I think this draws on Phil Tetlock's argument, which is if you're worried about big risk, don't listen to the experts. They're going to kind of misestimate that risk. Focus on a crowd estimate of that risk. And I think that's the difference. You are outside, because what other choice do you have? You can do navel gazing and try to assess that catastrophic risk, but the truth is you will never have enough information, no matter how much you read, to make that assessment. Let the crowd do it, because they're going to get that collection of knowledge coming from very different parts of the world and very different businesses making that judgment. And you're absolutely right. You have to crowdsource some of your work. Otherwise, you're going to drive yourself crazy.
So a couple questions. The first is you mentioned or referenced the dollar. And while the Trump administration and investors will highlight that the S&P was up, I think it was up 17% last year, if you adjust for the dollar's drop in value against other major currencies, the S&P underperformed almost every other major market. And it does feel as if the US dollar is under attack, and the catastrophizing around the dollar losing its status as reserve currency. Rumors of the dollar's demise have been greatly exaggerated, except it does feel wobbly right now. Curious to get your thoughts on the dollar and how it intersects with different markets.
I think it is wobbly because I think it's wobbly for multiple reasons. One is concerns about the Fed and inflation play out in what currency you trust. Part of the trust in the dollar came out again of that post-Second World War acceptance of the dollar as the replacement for gold. I mean, that's effectively what happened. Instead of the gold standard, is the dollar standard. And the dollar standard was accepted initially because the dollar itself was convertible into gold longer than in any other currency, till 1971, 72, at least technically convertible into gold. I think that more you worry about inflation and central bank independence, the more you worry about the currency as well. So that's one component. Second is you can't separate the economic from the political. The dollar centrality here in the global economy came from the US being the policeman for the world, essentially being a center of the global political universe. And what you're getting, not just in the US, but across the world, where countries are stepping back into their local domains and saying, look, this global stuff, it's not for us. Even though I think it's too late to step back from it, I think that's going to play out in the dollar being the international currency, of choice. So it is wobbly. But what keeps it there is, what do you replace it with? Because if you look at every other choice, it comes with a whole load of issues as well, right? Are you going to replace with the euro? I'm not sure you want to go there because the euro has its own frictions. Are you going to replace it with the Chinese yuan? I don't think people are willing to make that transition either because you feel like you're jumping out from the frying pan into the fire. So what keeps the dollar there is there is no obvious alternative. Maybe there will be one that gets figured out. Maybe the dollar will revert back to being a currency that people trust. But I think that right now the dollar is wobbly, but I can't think of an obvious
earnings estimates. I would go to either pollsters or I'd go to, name the bulge bracket investment bank analysts to try and get some insight.
Not to culture or Polymarket.
You read my mind. And now I find myself increasingly going to Kalshi and finding it is increasingly a better predictor, the wisdom of crowds. One, what do you think of this phenomena? And two, what do you think Kalshi and Polymarket are both kind of threatening or flirting with the idea of going public? And we've seen a massive, I think, transition of market capitalization from the betting companies to the prediction markets. So one, your view overall on a meta level of these prediction markets, and two, looking at these companies as potential stocks to own.
It goes back to what I said to Ed earlier about the catastrophic risk assessment, that the crowd judgment is more reliable than expert judgment. And what I think you get with both Kalshi and Polymarket, and both have their own frictions and issues that we have to get through, is you're getting a crowd judgment. And that crowd judgment, these markets are not every Kalshi market is a good one because some are very liquid and lightly traded, and one big trade can move it. But if you take the big, I tracked both Kalshi and Polymarket during the presidential election. And actually, I wrote a piece about how well or badly they did against, 538.com and all the other sites, the pollster sites. And they clearly conveyed information much more quickly. They responded much more quickly to what was happening in the ecosystem and with a lot less bias. In fact, I recently saw a study where they compared, I think, Kalshi and Polymarket's predictions for the Fed's rate corrections and rate adjustments relative to experts, and they discovered that they did better than the experts did at forecasting things that they should have the most expertise in. So I think that they will continue to evolve and play a role. It comes with a whole host of things we have to deal with in terms of potential side costs. Right? You see this in sports betting, right? With FanDuel and DraftKings allowing you to bet on small piece of things. It's also brought, problems with people playing games with it and effectively exploiting it to take advantage. And I think that's going to come. But I do think that they will continue to prevail and grow because they deliver better predictions. Now, when they go public, will I buy into them? The question is, what's proprietary about what either does? They have a platform, a lot of players, and I think there's a stickiness there for the moment, but I think the stickiness is not deeply embedded yet. Both are very young platforms. So if you came up with a third platform with lower transaction costs and ease of trading, that might be my concern. I think the overall business is going to grow, but the companies that end up dominating the business will be a shifting target because I think it's still evolving as to what the competitive advantages are in these markets and which one you would want to bet on if you wanted to bet across them. Kalshi's initial benefit was Polymarket, I think for a long time, required you pay, it had to be in cryptos in a different setting. The transactions costs involved were greater. But I think they will continue to see the transaction cost issue come to the forefront and how well these markets are actually structured because they have a lot of testing to go through. They're still very young markets and they haven't been quite tested in terms of the prices they deliver. But on both counts, let's face it, the original crowd judgments came from financial markets. It's in a strange way, people are making a case for market efficiency that was done in the 1960s, which is given a choice between trusting an active money manager or trusting the market, which one would you go with? The early University of Chicago judgment was go with the market. It's a crowd judgment. 60 years later, through a different route, we've arrived at the same conclusion about a whole array of things we do out there that are predictions, where the crowd judgment is replacing the expert and delivering a better result.
Are you saying that you would have been better off in the 60s just buying the S&P versus going into the alternative investment market with its fees?
Absolutely. The only reason you didn't know you were better off was you got one statement every year from your mutual fund saying, look how well we did for you. We made 9.8%. You had no peer groups to compare. I mean, active investing has always been problematic. It's always underperformed the S&P 500 or the index of that's best suited to compare it to. But for a long time, that underperformance was not clearly visible to many people invested in, and the choices that you had were limited. Until you get to this century, if you didn't like the way your mutual fund was run, you had to buy the S&P 500 index fund. It was that or nothing. Today, you can buy an index fund that software. You can buy an index fund of software companies. You can have ETFs. You've now created passive investing choices. And I think that it's opened the door for active investing to get disrupted, and it has. Today, if you look at market share of passive investing vehicles, ETFs and index funds, versus active investors for the first time in history, more than 50% of the money in the market comes from passive vehicles, which carries its own consequences. And you can have an entire session talking about what those consequences are. But it is, in fact, always been true, but now we can do something about it.
I feel like what we're describing is a respect for the efficient markets hypothesis, which is the idea that markets are the real experts because markets are translating and filtering through and communicating all these different signals, all these different data points. And so generally speaking, the markets are the best at pricing in and predicting the future, which is something that I generally agree with. At the same time, I also know that you're someone who doesn't always believe in that hypothesis. An example being you believe that in certain situations, valuations can be too high and that certain risks are not being properly priced in or appreciated by markets. And I find this to be one of the difficult things in investing. It's kind of a paradox. It's like, on the one hand, we have to respect the predictive powers of markets. On the other hand, sometimes, every once in a while, we might think, actually, I think they've got something wrong. I think I know something that the crowd doesn't. So I guess my question for you, how do you decide which one to believe and when you should believe one or the other?
It's a great question because in many ways it creates a tension between the wisdom of crowds, which is the heart of all crowdfunding, which technology is bought in full time into, and the madness of crowds, which is one of my favorite books. It goes back 200 years, which is crowds can sometimes do strange things caught up in the mood at the moment. And I think that tension continues. So even when you believe in efficient markets, you have to accept the fact that markets can make some humongous mistakes because the crowd basically does the wrong thing. And the question is, can you take advantage of those mistakes? Right. I think when you talked about what it is that makes markets special, it's two things. One is that markets are aggregators of information. I remember a story that Gene Farmer told me in the early 80s. I was his RA for a couple of summers when he came to UCLA. No. And Gene Farmer, of course, won the Nobel Prize for his efficient market work. And he said, if you have a market, we have 100 people, each of whom brings in one small piece of information, the market price, markets that run well, will aggregate that information because each person will trade that piece. So it's an aggregator of information. And the second advantage markets have is you're putting money behind your words. An expert gets on CNBC, you can say whatever you want, right? There's no money behind it. You can say outrageous things because you know that if that event happens, even with small, you're going to look like a guru, an expert, because of saying it. Markets have real money in their aggregators, but markets can go off the tracks. And it's a tension I face every day as an active investor. Of course, if you invest in index funds, you basically made your choice. You're saying madness versus wisdom. Wisdom wins out over madness. In the long term, I'm incapable of catching that madness when it happens. I'm going to go with index funds. The very fact that I actively invest in stocks means that I hold on to the hope that when there is this madness, and it happens, I am able to overcome my own psychological issues, because when crowds go mad, it's very difficult to actually go against a crowd. You're cutting against a conventional wisdom. So right now, you buy a software company, everybody's saying, what's wrong with you? Why would you buy this disrupted sector? You got to live with that psychological discomfort. But if you can do it, I do think you can take advantage of the madness of crowds, but I can't offer guarantees. That's a faith part. No, so it's entirely possible you could try and try and try and have nothing to show for it 50 years from now, after 50 years of active investing.
Just going back to the catastrophic risk, which I'm sorry, I'm a little obsessed with right now. One thing that I keep on thinking is markets may look very different in 3 or 4 years if Trump is out of office. It seems that a lot of the concern and the uncertainty and the risks that are being discussed right now, whether it's because of what we're seeing with Davos or the increased deficit spending in the Big Beautiful Bill, or threatening to invade allies of NATO nations, et cetera, it's all very much a Trump story that seems to be driving a lot of the uncertainty, which makes me think, well, if Trump isn't in office, then maybe we live in a very different world. But then the question, of course, becomes, is this permanent? Have things changed for good? What is your view on this question?
I think a lot of the things that Trump has kind of pushed to the front are things that have been evolving, happening under the surface before. He's been somebody who's pushed it to the forefront. Let's take an example, right? The independence of the Fed. I think Fed independence has been chipped away gradually over the last few decades, partly because the Fed's become too full of itself. Now, too full of itself in what way? I mean, the Fed actually seems to have bought into this notion that it can set interest rates, it can drive the economy. And you can go back and blame Alan Greenspan in 2001 saying, I will not let the U.S. economy go into recession after 9/11. There's the hubris of central banking kind of caught up in its own sales pitch. So the independence of the Fed has been slipping away the minute the Fed decided to put itself into the public domain. I tell people 40 years ago, if you'd asked me to name anybody but the Fed chair, I wouldn't have been able to name a single person on the Fed, the FOMC. Today, they're all making speeches. They're on CNBC. They're touting their own different views about where the market is going. I think so. The independence of Fed has been an issue well before Trump came along. Of course, he's pushed to the forefront with this, back and forth with Jerome Powell and what Kevin Walsh is going to do. So, you take tariffs, right? Again, you can say this was Trump's doing, but this is something that got kicked into process about a decade ago when the blowback to globalization started, politically first. And then economically, where people said, you told us globalization was going to be great for us. And I'm talking about the people who were disrupted in the global. So if you think of globalization as a disruption of how business were run, they were the disrupted there. But they were often forgotten. They ended up becoming the drivers of political change. So starting, the first Trump election, but with Brexit, you can go through a whole series of political movements. You can argue that this unraveling, or at least the pushback against globalization, was something that happened before Trump. So I think in many ways, as you see Trump push these issues to the forefront, his going away is not going to make them go away either. There are underlying political and economic forces that came in before he became president, will continue after he leaves. And I have a feeling that 2028 and 2030, you might not be talking about Trump, but you might be talking about somebody in Europe who's risen to the top of the ranks, who brings Trump-like attitudes towards globalization and the global economy. This is a shift that I think will outlast Trump, and we have to adjust to a different world order than the one we were used to 20 years ago or even 15 years ago.
You'd mentioned high margin company that hasn't innovated, it doesn't adapt very quickly, is ripe for disruption. Obviously, ground zero, check, higher education. And yet, applications up, margin power up. Is it the fact we have a duopoly? Is it artificial scarcity? One, I do not see anything resembling disruption in the numbers. And two, is that a dangerous thing to say? Like, what are your views? I just looked at all the data on applications, there's some things happening. People want to send their kids south. They don't want them to send to a protest. They want them to go to football games and join fraternities and sororities, not protests, is how I read. The only thing I sussed out of the application trends. But I see nothing indicating any sort of disruption that I won't say you've been predicting, but I've been predicting for a decade.
I think two things. One is the price fixing in college education is obvious. In a world which is competitive, you should expect to see tuition vary from 15,000 at some schools to 100,000 for others, right? I mean, you don't see that. So clearly there's clearly price fixing. The second is the federal government has subsidized this price fixing with its, look at the size of the student loan. It's trillions of dollars. That combination has insulated universities from feeling the consequences of their own. So if you raise tuition by 6% and any other business, you should see some blowback. But the way the system is structured is it's been buffered. Now, I do think that you're seeing the change in graduate schools, MBA programs, increasing number of one-year master's programs. So what's the big deal? Because people look at 2 years and saying, that's $200,000, and unless I'm going to go work for an investment bank or in a hedge fund, how the heck am I going to get my money back? So you're starting to see.
So I need Damodaran's class, but I don't need Galloway's? Is that what you're saying?
No, I think, but I think in 1 year, they can take both our classes and dispense with a lot of other classes. And you're seeing this as Stern as a bunch of 9-month programs focused on fashion and entertainment, because there's no way you can get a 2-year MBA and get your money back if you're going to go back into fashion or entertainment. There's not enough of it. So I think that's where you're going to start to see things. A 4-year is going to come under pressure, maybe go to 3 years, and then the graduate schools are going to get shorter, because you have 6 years if you have undergraduate and graduate, and you pay full tuition along the way. I don't see how you make your money back. It's just not going to happen. The second is there's a lagged effect. We're still preparing our kids for the white-collar world that dominated for the last 30 years. You don't want your kid to be a factory worker because you saw what disruption did to them. But what AI is doing, in a sense, is it's disrupting, but that effect is going to take a while to start to show up. So maybe in the next generation, people will be pulling their kids out of college and sending them to plumbing or electrician school, because that's where the payoff is going to be greater. And that might not be such a bad thing for the world, actually, to have fewer people going through 4-year programs that teach them very little in life skills that they can actually use to make a living. So, but it is going to be slow, because it is, the parents often still make the choice of whether you go to school or not. It's not the kids themselves. I have the feeling that the disruption would have been lot faster if kids bore the cost and then they said, how am I going to make my money back? So we, as a parent, I've buffered my kids from having to deal with I admit it openly. And I did it because I didn't want them to worry about having the money to go to college, but maybe that's not a good thing. Because in a sense, they can now take, I heard a couple of college students the other day talking about, why would anybody graduate in 4 years? Take an extra year. That's when you have fun. If you actually, that's a lot of money to have fun. An extra $150,000. If you had to pay that money, would you stay for a 5th year? I don't think so. So I think that we've insulated the people in our universities from the financial consequences, either with parents paying for the tuition or the federal government coming in and giving them financing at the tuition. It'd be interesting to see, because I think there was a cap that was put on the tuition aid at $50,000. A number of universities this year have actually lowered their tuition to match the federal cap at $50,000, so you could qualify for that. It'll be interesting to see whether there are things that the government can do to kind of drive down the cost of university education. But the problem is, for that to happen, universities can't keep that you teach 3 classes a year and you take the 7th year off for tenured faculty. So there's a whole system that's been built on this on a tuition that you can pass through to students that will not survive if you alter that system. So this year was a terrible year for econ, for PhDs looking for new faculty, new jobs. The market for PhDs has dropped off significantly. So you're going to start to see that play out first, and then maybe the ripple effects. But you're right, Scott. You and I have been calling for the disruption, but I think it's been such a slow motion disruption that you don't notice it inside the universities yet. And until that pain is felt inside the disrupted, you're not going to get change.
Final question from me. Outlook for 2026. I mean, if you look at the US stock market right now, perhaps even looking at emerging markets, maybe European markets, but I guess I'm really interested in what you think is going to happen to US stocks by the end of this year. What would be your outlook?
I think we're due for, if not a correction year, a flat or a normal year. I have a feeling that this is a year where the economy is going to do better than we expected, but markets are going to do worse than people think. And that's going to be the reverse of what we've seen for quite a few years now. So that would be my prediction.
Aswath Damodaran is the Kirshner Family Chair in Finance Education and Professor of Finance at NYU Stern School of Business, where he teaches corporate finance and valuation. You can also read his research on his blog, Musings on Markets. Professor Damodaran, always appreciate your time. Thank you.
Thank you, Ed.
Thanks, Aswath.
Thank you, Scott.
Ed, what'd you think?
I'm always blown away by that guy. God, there was a lot in there. I think that the catastrophic risk that he brought up at the very beginning of the show is extremely, significant, concerning, but I do think that it needs to be taken with a grain of salt. And I think if we had maybe 3 or 4 hours, I'd want to drill down exactly what are his genuine concerns, because a lot of the stuff that he was pointing to was just price action. And as I said, that's a signal, but it isn't everything. And I'm not saying that he's predicting the end of the world, but I think his point is that there's a lot of catastrophic risk out there that isn't being fully acknowledged. I don't know if I fully agree with that. I think that, gold prices rising as much as they have is an example of that risk being acknowledged. I guess his point is that we're not quite seeing it in the stock market. It's something that we really need to drill down on. I also want to get Ray Dalio back on the podcast, because as of this week, he wrote an article. He said it's official. The world order has broken down. And he's been talking about this and writing about this for years. The world order is on its way to collapse. American hegemony is on its way out. That's going to mean the rise of gold. Of course, that is exactly what happened. And now his view is it is over. So there's a lot of catastrophizing out there. And to Aswath's point, it's not coming from the usual suspects. It's coming from people who are pretty rational and reasonable, and who have been for a really long time. But I think that is my big question mark following that podcast that I'm going to be thinking about and digging into.
So I'm starting, and I'm in the midst of selling down my U.S. stocks for a variety of reasons, but he makes me feel better about it, because it's always, I think what makes you a great investor, it's like when you summit Everest, people celebrate, and that's a big thing, they plant a flag. But what they fail to realize, or immediately that fact, mountaineers, enters their brain, and that is the majority of fatalities are on the way down. And I think what separates good from great investors is when to sell. It's very difficult, it's very hard to know when to sell. And when I look at the U.S. market right now, and Aswath, I think in a more measured way, I just think there's some.
Ended the day slightly down, basically flat. However, the real headline came in the company's outlook for 2026, which revealed that the company would incur $1 billion in costs due to tariffs. So, more evidence that tariffs are indeed funneling through into earnings. Procter & Gamble, possibly the most consumer-facing company in America, they own all of your classic household names: Gillette, Pampers, Tide, Febreze, Pepto-Bismol, Old Spice, etc. They are about to take a $1 billion hit, which would be one of the largest single tariff impacts we've seen disclosed by a US company thus far. Meanwhile, and more importantly, They also added that they are not just going to eat the tariffs, as was at one point suggested. They said that they are going to pass on the costs to the consumer. That is what we learned in this earnings report. So let's take a look at exactly what was said on the call. According to the CEO, quote, "Tariffs alone are a 5-point headwind to core EPS growth in fiscal 2026. We will look for every opportunity to mitigate these impacts, including sourcing flexibility, productivity improvements, and pricing with innovation." Now, what does that actually mean? What does pricing with innovation mean? Well, later on in the call, the CFO got clearer. He said that roughly a quarter of all P&G products are impacted by the tariffs. And he said that we can expect the prices on those items to increase in the, quote, mid-single digits. So we're looking at something like a 4 or 5 or 6% price hike on everyday items like laundry detergent and toothpaste. And by the way, those increases are expected to hit sometime next month. So we wanted to get some more detail on these earnings and what they say about the tariff environment. So our producer Claire spoke with Nick Modi, Managing Director at RBC Capital Markets.
It was a tough quarter, but expectations had come down as the quarter progressed. So the bottom line is, it's a function of the macros. We think they're going to be investing quite a bit as we roll forward to kind of regain some momentum in the market as they launch some new products. And then tariffs, look, this is obviously going to be an issue that we're going to all have to watch market-wide in the back half of the year because companies have effectively been holding back on, taking a price increase to see what the actual tariff strategy is going to be. Are they going to be around? Are they going to be moderate? Are they going to be heavy, like what we were dealing with a worst-case scenario with China with the total 145%? So the reality is, I think all the companies are waiting to kind of understand and have clarity before taking any price action, which is why you heard Procter talk about taking some price in the back half of the year, right, to account for some of those tariffs to offset them.
This is one of the first instances we've seen of a company really explicitly saying we are going to raise prices to handle these higher tariff costs. And as you said, it seemed like they were maybe pushing it off towards later in the year, but now they're finally coming due and they're saying we will raise prices on the consumer. Do you expect to see more of that from companies like Procter & Gamble and other consumer companies?
Yeah, I think like what Procter explicitly was saying is, listen, we don't know exactly how everything is going to play out, but what we know right now, we're just basically assuming that's going to be the reality, which is, I think, probably the most effective and appropriate way to actually deal with this very uncertain, volatile situation. I do expect other companies to have similar types of reactions, right? Again, we hear a lot about, look, tariffs are going through and we've not seen any inflation. The reality is a lot of the companies are just waiting to understand exactly what the cost structure is going to look like before they actually figure out what they want to do with their cost structure or pricing. Right. And so that is what I think we all have to kind of anticipate over the next several quarters is as companies get more clarity, they're going to start responding. And that's where we're going to start seeing some more pricing in the market.
Well, I think the lesson here is that this is almost exactly what we all predicted. I mean, if you had to model out what 15 to 20% tariffs would do to the earnings of a consumer staples company, it would basically be this. It would be an increase in costs that is ultimately split kind of evenly between the shareholder and the consumer. The shareholder eats some margin compression and the consumer eats a price hike. Not a gigantic hike, not so big to the point that you actually can't afford it. That wouldn't make sense. But big enough that your life is noticeably more difficult and less comfortable. And that is exactly what we're seeing here. The shareholders and the consumers are sharing the burden exactly as we all thought they would. And I think that's important to keep in mind. Because for all of the expert bashing and textbook bashing, for all the people who say you can't trust your professor or you can't trust the experts, it turns out, in this case, that actually, no, you can. You can read an Econ 101 book. You can see what it says about tariffs and how it affects the economy. And you can estimate with some degree of confidence that things will play out the way the textbook told you. And that's what we're seeing here. This is very simple economics that is now playing out in the real world. As the P&G CEO John Moeller put it, tariffs are, quote, fundamentally a 30% jump from last year. So just a monster quarter for SoFi. Net revenues up 44%, user growth up 34%, fee-based revenues up 72%, and the market is going crazy for it. Shares surged as much as 15% yesterday, and the stock has more than doubled since April. So you might think that based on the market's reaction, this was a one-off, but actually, this company's been growing rapidly for some time now. Back in 2020, SoFi had just 1 million members. They now have nearly 12 million. And in that same period, they've gone from this small, non-FDIC insured online bank to a company that offers almost everything, from credit cards to retirement accounts, options trading, student loans, debt consolidation, and so on. In the words of the CEO, SoFi's biggest problem is, quote, deciding what not to do. So to tell us more about this company and what these earnings tell us, Claire spoke with Dan Dolev, a senior fintech analyst at Mizuho Americas.
Yeah, look, this was an inflection quarter in our view. And I think what is the most important thing here is the lending platform, right? Like that's kind of the big growth engine. And a lot of people didn't appreciate it until now, but now it's sort of coming back. So, that lending platform is something to watch out. I think the other thing is the delinquencies that keep coming down. And the biggest surprise of the quarter was the mortgage originations. That was because, this is all idiosyncratic, right? So the market hasn't come back, but SoFi is coming back. So it means that if the market, so it's up like 90% year over year, if the market were to come back, it would mean even more growth down the road.
It seems that SoFi is not only competing with traditional banks, but it's also outcompeting other digital banks. Would you say that's correct? And if so, why?
100%. So let me just give you an example. So, they compete in the US with Chime. But if you think about like them versus Chime, Chime only caters to like lower people with lower income, and their products are more limited. So they have a debit card, and it's pretty much that. But SoFi has just so much more variety, right? All these products. Now they're getting into crypto, they're getting into stable coins. So there's going to be a lot. It's the diversification of revenue, which makes it great. Plus the brand is really strong, right? They're the only ones that have like SoFi Stadium, right? Football stadium under their name. People know it. It's in, namesake. And this is what makes them sort of the most prominent digital bank in the US. And I think that gap is going to continue to bifurcate over time. Just to give you some perspective, back in the day when the stock was at like, $7 and everyone was telling me that I'm crazy for having such a, big bullish view of SoFi, people were highlighting the fact that they can only grow the lending product so much because at some point they hit sort of the capital ratio maximum, right? So if you're a bank, you can only lend to a certain degree until you hit some sort of a CET1 ratio, which basically means like you cannot lend more unless you issue more equity. And then they came up with this lending platform, which basically allows them to do off-balance sheet lending. And this basically widens the TAM to infinity because they can lend as much as they want as long as they keep delinquencies in check. And you're seeing delinquencies are actually kept in check. So this is the biggest growth area. And this is going to continue to be the growth area because as they do better, they're getting more committed capital from outside funds that are giving them money to make loans. And you're creating this virtuous cycle, which is unrelated and uncorrelated to any banking ratios. So they're kind of freed up from this banking ratio. They're kind of a marketplace for loans right now.
Now, usually after a huge pop like we've seen yesterday, we, at least at Prof G Media, have a tendency to be a little bit skeptical. We're usually looking for reasons as to why the market is too excited or too enthusiastic or just carried away. But in the case of SoFi, we cannot see much to dislike. And the thesis is quite simple. And that is when it comes to financial services, there is basically no more obvious and inevitable trend than digital banking. And as of today, SoFi is the leading digital bank, and it is therefore best positioned to ride that wave. And this is mostly a demographic observation. Only 20% of Americans have digital-only bank accounts today, but that number's been growing rapidly, and it'll only continue to grow. Why? Because of young people. Young people increasingly value the ability to do everything from their phone, and banking is no exception. 96% of Gen Z uses online banking today. You compare that to the boomers, where the number is less than 70%. And this is why banks like SoFi offer no in-person branches. They recognize that young people don't care about being in person, so why waste the money? Meanwhile, the cost they save on the overhead allows them to invest in other things like, for example, higher interest on savings accounts. In the case of SoFi, it's 7 times higher than traditional banks. So this was a big quarter for SoFi, but we also think it's a good reminder of this digital battle.
You know me, I like to get to know my staff. I like to spend quality time with them.
We did spend some quality time.
We
got
did.
kicked out after about an hour. The other thing is we went to a bar that we were very excited about, and I show up because Scott showed up a little late, and I show up, and it turns out that it's comedy night.
Comedy night. And there's some Scotsmen on stage speaking a dead language that only twins speak to each other. And they closed the bar down. So I'm like, oh, this fucking sucks.
So we had to spend the first 20 minutes listening to this guy. I got to tell you, he was absolutely bombing as well. It was not comfortable to sit through.
Yeah.
But then we had a lovely drink.
I got to know your girlfriend. I just sat there and thought, what does she see in him? I don't get it. I don't get it. I don't get it. Ed, I don't think young people should get married, but my advice to you is 3 things. First, lock. Second, it. Third, down. Lock it down. It is. I think the world of you. You are so out of your weight class, my brother. You are so out of your weight class. Anyways. It's good to see you.
That's very good. It was great to see you. She had a great time. I had a great time. It's good to be in London.
It's nice, right?
Yeah, it is very nice. It's too dark and it's a little late, but it's nice. Well, we have a big, important interview here with the CEO of Kalshi. Shall we start to move on to that?
Let's do it.
Okay. Actually, before we do that, apologies.
Let's not.
To also say...
Go ahead.
I forgot to also say that Prof G Markets is returning to the Vox Media podcast stage at South by Southwest. We will be there on Saturday, March 14th. So if you want to see that, come join Scott and me at 10 a.m. on the 14th of March at the Hilton Austin for a live taping of Prof G Markets. Live show. It's going to be epic. Scott and I, very excited, or at least I am. I think Scott's excited.
You had me till you said Hilton Austin. That's not what I aspire to, but you know what's going to happen here? It's the same thing. We come in, we skirt the line, and a few people take a picture with me, and they're like, oh, and by the way, I have a daughter. She's at UT. Is Ed single? Is Ed single? Everyone is asking about your romantic status when we go to these things.
That's not what happened last night, where we're standing together and then someone comes up and goes, oh my gosh, Scott Galloway. And he looks at me, he's like, I know you too, but Scott Galloway, it's great to see you.
The tall, handsome guy?
That's right.
He is a tall drink of lemonade, like a nice, young, handsome man. Yeah, yes, I enjoyed that. I enjoyed meeting him.
Yeah, it was good. It was very good.
Yeah, but South by Southwest, and you can learn more and get a special discount. I love how they're already discounting us. That makes me feel good. On your South by Innovation badge at voxmedia.com/SXSW. That's voxmedia.com/SXSW. We'll see you there. I'm actually really excited. How many people from Prof G are we bringing to Austin, Ed?
We've got a huge crew. I think it's like 12 people, maybe?
I heard 16. I wonder how much money that's going to cost me. Oh my gosh. Yeah, I'm excited. Anyways, everybody, Ed and Scott are going to be at South by Southwest. Please say hi. We really do enjoy meeting our fans. And Ed, not so much. Ed's sort of standoffish and a little bit arrogant, thinks he's better than everybody else, but not me. Not me. Not me. Say hi. Hola. Hola, el perro y el absorbo do self young person, young man. See you at South by Southwest.
No comment. Here's our conversation with Tarek Mansour, co-founder and CEO of Kalshi. Tarek, good to see you. Welcome back to the show.
Thanks for having me, Scott and Ed. I'm excited.
So it's been a little over a year since I first interviewed you on First Time Founders. A lot has happened since then. Just looking at Kalshi as a company, your revenue has grown by about 1,000%. Your volume on this platform has gone from $280 million to $2.3 billion. You also recently raised $1 billion at an $11 billion valuation. Basically, we knew Kalshi was going to explode, but it's exploded in a way that is kind of larger than life and getting a lot of attention. I'll just start with this. Why is Kalshi so popular right now, and why are prediction markets so popular?
One, it's just the exponential. When the numbers are small, the exponential, you don't really feel it quite as much. And then as you compound and compound, all of a sudden, everything basically happens all at once. And you tend to see that with sort of with a lot of consumer businesses that really hit the mainstream, and they're growing at an exponential or exponential looking pace. And I think that's definitely happening in prediction markets, or at least in the case of Kalshi. The second thing where I think we're benefiting quite, I think that prediction markets are benefiting from an overall societal wave, which is sort of this general distrust in traditional news sources or information sources. And I think people are looking for an alternative. And, I think they found it, a lot of people have found it in podcasts. I don't think a lot of people have found it in social media. I think people have, social media had this kind of idea of, crowdsourced wisdom or crowdsourced truth, but social media incentivized clickbait in a way that, people over time are not feeling like, the news feeds are basically like split into two. The word is basically completely dispersed. Everything is polarized. And prediction markets are in some ways some sort of antidote where you get the crowd wisdom. You have a lot of people participating in prediction markets, but you have skin in the game. People are putting money where their mouth is, and that leads to some of the answers they get out of prediction markets to be more accurate. And that's been definitely a big catalyst of the growth.
There are two things I'd want to kind of separate in this conversation. One is prediction markets as a content platform, which I totally agree with you on. It's been massively helpful for us. I think a lot of people find it interesting because it just tells you a little bit more about the future. If you're trying to understand an issue, you will go to the prediction markets and you'll find the question, and then you'll get to see, like, this is what the consensus view is. This is a probability of this event occurring or not occurring. That's content. It's also a trading platform, some would say a gambling platform, which is a different kind of thing. And it brings with it a lot of different issues. And I think as this platform has gotten so popular over the past year, it has also drawn a lot of criticism. And I think a lot of that criticism is reasonable, valid, worth talking about. So I guess I'd love for us to dive into those criticisms. As the founder of this company, as the CEO, what would you say is the overall, let's say the 3 or 4 biggest criticisms of the company right now, based on what you're seeing, based on how things are being reported? What would you say are the issues that people are worried about when it comes to prediction markets and Kalshi?
Any consumer company, and this is one of the things that we've learned, and I'm learning in real time right now. Most consumer companies that hit the mainstream, they go from like really exciting new technology, and when they hit the mainstream, there's this sort of flip where all of a sudden, there's this sort of like, let's just kind of air out all the risks, the dangers, all the ways that this could go wrong. I think we've seen it play out with Uber. Airbnb had its fair share of it. We're seeing it play out with AI on many dimensions and many levels, and we're seeing it play out in prediction markets. And to some extent, I think that's a healthy thing. Like, I think society having a debate about new technologies and how to kind of deal with them is a good thing, right? If we all agreed on everything, we probably are headed in the wrong direction. Look, my understanding is like there's one, this question of like, is this gambling? Is this different? Are there kind of concerns about addiction and social isolation, young men? I know you guys, Scott, you talk about this a lot. I think number two is there's the concerns of insider trading. Like, and to me, I bucket it into kind of, is the market fair? How do we police it? What is being done about that? But to me, I don't think it's totally abnormal, given the rate of growth and how fast this basically has gone mainstream.
Well, just to double click on that. So there's a real fear that a lot of big tech or a lot of technology companies, as they scale, tap into a less mature prefrontal cortex of men looking for dopa hits, and that essentially prediction markets are sort of the high IQ or graduate education version of gaming apps, and that it preys on a dopa-hungry male, and that there's enormous incentive for well, first, let me start there. Who is your typical, what's the demographic profile of your average customer, and what is different from speculation or prediction markets from just flat-out gambling sites?
The vast majority of volume is really in the bucket of 25 to 45 years old, and then we have a bucket in 60 plus, so retired, has sort of disposable income, time on their hand, and I think that when I think about the typical customer, there's been recent reporting, which I think was pretty interesting about this. You might have, I don't know if you've seen the New York Times article about the rise of the prediction market trader, and they kind of gone through a number of, and the most active traders, the people that basically, drive a lot of the activity on the platform, people that you would kind of consider like a super user or power user. Those are the people that are spending quite a bit of time modeling. I'm passionate about the economy. I read the news a lot, and I'm going to basically be forecasting inflation on a daily basis. Or I like mention markets. Joel, there was a whole profile on him on this New York Times piece, and the guy has built pretty sophisticated models of what words are going to be said and what appearances, and those are people that have had an interest in something, and then they figure out an outlet to basically make money off of it, or engage with a community that has kind of that shared similar interest. These are the most engaged in our Discord, or we have this Kalshi Idea platform, which is basically Twitter, but you can only speak if you have a position. So it's kind of a Twitter that's filtered for people that are position takers. But to me, it's I think the concern that you sort of outlined is a real concern, right? I think, in my view, any financial markets, and I think this concern applies to any financial market. I think it applies to, day trading of options, or this kind of idea of zero DT options that settle on any given day. Retail trading, I think it applies to crypto, also the meme coins, and obviously it applies to traditional gambling and sports betting, and that risk exists in prediction markets. And I think the way that I think of it, and as I build a company and as this company scales, there's certain things that are intrinsic to the model, and then there's guardrails, things that you add to the model around your business model to basically protect consumers from this sort of thing. So let's talk about the intrinsic piece. So I think prediction markets is a much healthier mechanism to engage with something than a lot of these other mechanisms. I think a lot of the problems that we've seen with dopamine hits and addiction, and a lot of the issues that people generally pertain to as gambling, have come from the gambling industry. And I think, and you ask why, well, you got to look at the incentives in that industry. When you go to a casino or you go to a traditional sports book, the revenue of that company is equal to the customer's losses. The way that whole system, the business model is well, if ad comes to me, the business model is figuring out how much money can I take from ad. That's how it works. So if that's your business model, what are you going to do? Right. Well, what you're going to figure out is okay, I have Ed and Scott as customers. If Scott is a winner, I'm going to block Scott from participating, because anything that Scott wins, it's going to take from me as a business. And if Ed is a loser, I'm going to figure out how to create a habit, how to get Ed hooked in the platform and get them to come back pretty consistently. And that to me is a lot of where it's a perverse incentive. And show me the incentive, I can show you the outcome. Well, what the outcome is going to be is basically you're going to get people hooked, and dopamine hits are going to basically be increasingly bigger part of the platform, and so on and so forth. Prediction markets just don't have that inherent incentives. I take a small fee, and Ed is not trading against me. Ed is trading against Scott. It's inherently just more social. It's inherently more I think the model doesn't have this sort of embedded perverse incentive. And that enables me as a business model to just have much more versatility around solving that problem, around creating really good guardrails around that problem. When Ed comes, he's not basically facing an algorithm that's just sort of optimized to get Ed hooked. Ed is facing Scott. is facing you and is figuring out whether Ed could be smarter than you, whether he could do research, how can he beat you. Intrinsically more social, intrinsically more competitive, intrinsically more interesting. In terms of the guardrail, we focused on this a lot. And I think that like a lot of the guardrails are really what you want to prevent is excessive behaviors. I think anything taken to the extreme is bad. And you know, I talked about some of the trading, like retail trading, some of these examples, but you know, you see it in other places. You see it with drinking. You see it with online shopping. Like you probably have I'm the type of person, like I have a bunch of shit in my house, like because I have these Instagram ads that keep feeding me all these like random trinkets that I keep sort of like clicking on and buying. And I think that's a form of excess. Like I somehow like find my, you know, I do the thing and then 5 minutes later I'm like, why did I just buy that? Like why, you know, and I do this on Amazon, I do this on Instagram a lot. And all of these things taken to the excess tend to be bad. And so how do you, you know, you have to create measures on like, okay, how do you prevent excessive behaviors? You have to do a lot of customer education. We have tools around self-exclusions, limits, pauses. And then we also have surveillance where like when we do find someone, especially on the younger side, you know, we do have age gating. So you cannot participate as a minor, obviously. But someone on the younger side, you know, repeatedly losing, repeatedly kind of taking aggressive actions, doing too much of their portfolio, we start showing warning signs like, hey, you should not put more than X% of your portfolio in one thing. Because, you know, again, like long-term, if you want to build a healthy ecosystem, you don't want these sort of behaviors to go off the rails. But then also our incentive is not misaligned with those guardrails. In some ways, it is aligned. We want people to be long-term participants in this model. We want them to be engaged socially. We don't win a lot if they come and lose a lot of their money very fast. That's actually a bad outcome for us.
The pushback to that point, though, you make the point, which I agree with, show me the incentive, I'll show you the outcome. The pushback for a lot of people to that would be actually the incentive might not be that consumers need to lose or that traders need to lose money, but they need to trade. And if you can get them addicted, if you can get them to keep trading and get hooked, ultimately that actually is a boon for your business. So the guardrails you're describing, they are inherently counter to the incentives that are built into your business, which is we need people to trade as much as possible because that is our business model. We're taking a transaction fee on all the trades that happen. We don't want you to lose money, but we want you to put some money up. What would you say to that?
I think there's a presumption in your question that's just assuming that all the trading is basically, you know, dopamine, you know, type behavior, right? Which is not the case, right? Actually, like, again, a majority of power users, the people that are really contributing the most volume are the people that are making these, are actually necessary. Their trading is necessary to this because they're making the forecast more accurate, right? The stock market doesn't get efficient if nobody trades. You need the trading and you need the informed trading. You need the well-researched trading. And actually the trading that grows the most over time is the winners, is the people that like are essentially very well-researched. They predict the weather because they're scraping satellite data. These are people that are building models. They're in the spreadsheets. They're doing math. They're building systems. These are people that are actually rejected from traditional, for example, like sports betting because they're making too much money. They get blocked and limited there, but they can come to prediction markets. It's a good home for that. So like, yes, you want the trading, but you know, the dopamine level trading is not necessarily the thing that makes the forecast the